Hello, everybody. My name is Bob Klefsaas, president of All Star Financial. I want to welcome you to our fourth quarter 2014 webinar entitled Oils Fall or Oil Prices Fall as the Dollar Rises. Two things that have created a lot of angst and some really good things in the economy. One of the first things that you read when you read our newsletter is upper right-hand corner. I talk about Bob's Corner. Bob's Corner is going to invite two of our newest members to the team, Brian Sensky and Karina McCurdy. We want to welcome them with open arms. As you know, Maren retired. Brian is coming in as our Chief Operating Officer as well as Chief Compliance Officer. Brian actually was an intern with us at All Star Financial back in 2003. Graduated from St. Olaf in 2004, got his master's in accounting, worked for Ernst & Young, then in the public sector for a while, and now he's back into the financial world with us. Really want to welcome him and his wife Jacqueline and three boys. Karina McCurdy, again, an account executive, going to work with us on client-facing as well as marketing. She has worked for Ameriprise the last 5 years. We want to welcome her. She enjoys her family quite a bit, and born and raised south of the river in Rosemont and Farmington. When we look at kind of the overview of the whole market economy, et cetera, we look at large cap stocks as being the standout and the most productive market to be in over this volatile global marketplace that we've been in. Who could have guessed that 6 months ago oil would have been 50% of the value it is today? Or today's price would be 50% of what it was then. Consumers are able to obviously spend more because they have more in their pocket. Some of the countries that are benefiting are the U.S., China, and India because they are importers to that product. The exporters of oil obviously have been really hurt. That's namely Russia, Canada, Mexico, Brazil. Also, Russia has gotten hurt quite a bit based on their sanctions. U.S. economy is continuing to improve, so market overall view is good. Employment continues to improve. Fed has stopped the quantitative easing, should remain to be seen as far as how the economy responds to that. Their last payment was on October 15th of 2014. So we'll see whether the economy can stand on its own 2 feet. And all during this time period, the dollar has strengthened by as much as 11%. So again, positive for the domestic market, negative for the international markets, as we'll talk about. And then Europe and Japan, their recovery is stalled. Central banks in Europe are continuing to ease. Central bank in Japan can't ease any longer. Their rates are as low as they possibly can go, but they're bringing to the table tax breaks to help the economy there. U.S. economy specifically, when you look at more jobs being kind of what we thought all along it needed to happen, that's finally happening. On top of cheaper gas, gives basically more spending power to the consumers. That's transitioned into a GDP that's plus 5% in the third quarter. Estimate for the first quarter somewhere between 3 to 5%. So again, hiring was really the key. We thought that if we could do somewhere on average of 250,000 or more over a 10-month time period, that's great. We've only done about 200,000, but the last 3 months have been almost 280,000. Unemployment as a result has gone down to 5.6. Full unemployment in the U.S. is typically at about 5%, so that's really good. Auto sales, energy production on the solar side, tech have all been positive. Capacity utilization, how fast or how efficient are we in utilizing our manufacturing and industrial? 80% is plus. It's probably as good as it's been since 2007. Housing remains a little bit weak though, but 2015 could be something that's better. Looking forward on our economy, you can see that the low oil prices, if they continue, obviously will be very good. Spurs the economy on, gives more spending power to us as consumers. The energy sector is hurt. That takes away jobs, so it could be bad. Business spending's up, which is obviously very, very positive. Wage growth could hurt. If we see that cost a little bit too much to hire new people, businesses might stop in that form and fashion. Economic growth accelerating, obviously good. Interest rates could go up, which would slow the economy down too. So we've got some good and bad, as you see in the economy and some of the things going forward. The bond market, as we've seen 32-year secular decline of interest rates, bottom out about 2.5 years ago. Since that time period, over the last 9 quarters, bonds have been negative over 5 of those quarters. So we're kind of bouncing off the bottom. Corporate high yields right now got hurt, basically because oil is about 16% of all corporate high yields have some type of oil related to it. So we saw high yields decrease when they normally would increase in this scenario by about 1%. U.S. investment grade bonds, however, did very well as the U.S. Treasury fell to 2.17. It's been fluctuating somewhere between 2 to 3 over the last 2.5 years, as I talked about the bottoming. And as such, bonds, when interest rates go down, bonds go up. We saw the Barclays aggregate index up plus 1.79, the U.S. government bonds up about 1.9, and Barclays U.S. credit about 1.7. Foreign bonds, on the other hand, because of the dollar strength, basically have had a tough quarter where we saw Barclays Global Index negative 1.04, as well as the emerging side of the world negative 0.55. When we look at bonds going forward, I think the consensus is that interest rates are going to go up. 10-year Treasury could fall greater than 2.17, but I don't think it will. I think it's going to go up with that dollar strengthening. I think that might help. But the Fed wants to keep rates low. That helps the economy. Default rates are lower with low interest rates. Global rates, we are higher than most global rates, so we still look better than most foreign countries' bonds. That's why we have such a demand that's continuing to pour in and lower interest rates. And the dollar continues to strengthen, albeit we have had a lot of debt put on our system. As I've talked about before, the U.S. dollar has had a lot of debt burden put onto it, but we are really the best of the worst when it comes to debt to GDP around the world. Emerging and high yield bonds, we believe to be still the best value by virtue of their negative returns here in the last couple quarters, but actually having the best value and the best yield to value. When we look at the domestic stock market, we look at the U.S. stocks, obviously setting the pace globally. The fourth quarter in particular, we saw the U.S. market earnings go up by as much as 9% for the year. Business spending improves through the hiring, as we've talked about. U.S. indices were really, in each style, were pretty much all strong. The broad market, Russell 3000, was up plus 5.24. Large cap stocks about 5% at 4.9. Mid cap stocks almost 6% also. Small caps finally had their day in the sun, almost a 10% climb, basically because of the boost in consumer spending. It hits home with smaller companies quicker, and smaller companies really are reliant on exports, which have been hurt with U.S. large caps because of the strengthening dollar. We look at what happened on the large versus small. Large growth was up almost 8%. Large value almost 5%. Leading sectors for the quarter we can see were utilities and consumer discretionary at 13 and almost 9% respectively. The trailing sectors for the quarter were energy at a negative almost 11%, and telecommunication at almost a negative 5 or 4.5%. When we look at the domestic stock going forward, what does that mean for us with all of this big bump up in the last quarter? We think the market's fully valued. There's positives that continue to present themselves as earnings are up, low interest rates helps, business spending is up, as we've talked about, whether it be hiring or the buybacks or the M&A. Corporate profits continue to improve. The negatives are that we have an energy sector that's being hit pretty hard because of the price of oil. About 50% of the Bakken production is being turned off, and that's going to obviously change the job market there. And to be honest with you, we're at the top of the market where we've had a really good run for 6 years. Whenever we go to the top of the market, volatility is created more frequently, and that's really what we saw this year. Until the fourth quarter, and this is what the amazing thing, the domestic stock market was pretty flat at third quarter end. It was just in the last quarter where the domestic market went up and internationals went down, where we had a pretty big separation. Good segue into the international. The dollar and the economic weaknesses really led to negative returns. When you see a dollar improve by 11%, that basically says when you repatriate that dollar back every night, that your international exposure that you own lost 11%. So we had some different feelings about the dollar strengthening. We'd like it obviously to get back a little bit more on par with the euro, so that the international stocks will benefit. Europe and Japan economies have shrunk. They're shrinking a little bit with the strengthening dollar. They're using their exports are going down a little bit. Energy prices have been hurt, as we talked about. European central banks, they're trying to do what they can. The dollar has strengthened by 11%. That hurts, as we've talked about. The Morgan Stanley Composite of Europe and Asia and Far East, the EFI was down 3.6%. Emerging markets down 4.5% for the quarter. Japan down 2.5%. China was the only shining star internationally at plus 4.62. So when you look at domestic versus international, domestic up 5 to 10%, and as we see, most international markets were negative. Going forward, our thoughts are we could probably see continued poor performance, but that again brings just more opportunity. Already, Europe is about a 20 to 40% cheaper buy than the U.S. The big question will be, what's going to happen in 2015 for the European earnings? Will they be better than the U.S.? If they're better than the U.S., we could see the international market exposures climb quite a bit. China and Japan, they have both been transitionally politically and basically are both trying to continue to keep interest rates as low as they can. As we've talked about, Japan has also instituted some tax breaks. Brazil and India, they have new political leaders. They're bouncing off the bottom. They are a little bit behind us, but again, hopefully we'll see some transitioning to from domestic demand to international demand in stocks, as people realize that they're just a better buy. In fact, in our newsletter, you can see on page 3 that when you look at the Russell 3000 PEs, they're right now at about 18.3 times earnings. The EFI is only about 15.6, and emerging markets are only at about 12.8. So a much better buy from a long-term perspective. When we look at a summary of kind of what's happened, we look at the U.S. economy and we say, okay, it's benefited from a couple of things. Hiring picks up. Economic easing is finally benefiting the U.S. It really kind of feels like the 1990s, But again, those had their ups and downs too. So it's kind of scary to kind of be where we're at. The rest of the world still is finding the challenges that they basically didn't start their easing programs as fast as we did. They're behind us in that. But again, that means that they've got some upside potential, just a matter of time. And the key, again, is expect the unexpected. Stay diversified. Nobody could have imagined that oil would be 50% of its current value or value that it was 6 months ago, or that interest rates would have dropped. I would have bet almost my bottom dollar that last year at this time, the end of the year, interest rates wouldn't be at 2.17%, but they would have gone up to probably 2.75 to 3%. So again, summary from that standpoint. Fourth page or fifth page of our newsletter, we want to talk about, and again, this is the newsletter that I'm referring to. I want everybody to read this as much as we possibly can. We think it's really tells a good story of what happened for the year. When you look at the domestic market, it really ruled in the fourth quarter. That fourth quarter return gave us a really a false impression of what happened in the market. And what we did is we put together this tactical asset management changes that we made. So really you can look at, hey, we did 6 things to prepare for 2014 and in 2014 that we really believed benefited you, and indeed they did. So let me read that. December 22nd, we sold our domestic large cap exposure of about 6%. Basically what we were saying, we wanted to take chips off the table. right before the first of the year because we thought the market was pretty overvalued. Certainly that happened just in the last part of January. The domestic stock market went down. We had taken some chips off the table and earlier in January on the small cap side of the world, another 6%. But in this first downturn in the market in January, the end of January, it was 10 days at length. All-Star Financial Models lost about 3.5%. Compared to the indices lost 5 to 6% worldwide. We saw a bounce that lasted until about June 30th. July 3rd, I think, was the top of the market. We pretty much stayed status quo until mid-year, and you can see how our growth in the market was on pace to kind of the market growth, but we started a lot higher than the market did after the bottom. So we could go and climb a little bit lower than the market did, but on the start of the third quarter, you can see that volatility continued to exist. We saw the market over a 24-day time period go down a whopping 4 to 6%, when the All-Star Financial Models only lost about 2.8%. We stayed status quo after the market bounced, but quickly, oil continued to fall and the dollar continued to strengthen. And even though it bounced up, it came crashing down again. And basically, we had a 28-day decline in the market. That 28-day decline in the market averaged somewhere between 8 to 11%. The All-Star Financial Models lost on average 4.6%. It was at that time in early October that we took chips off the table and invested into two different mutual funds. We invested into a diversified infrastructure fund that's going to take advantage of the aging highways, bridges, and water systems. And we also took advantage of the market being down and bought a global real estate fund that we believe will help combat the portfolio for a burst in inflation with this hard asset worldwide. And then we saw a gradually increase after, as you can see, towards the last third of the quarter, in the third of the fourth quarter. And then we saw that fourth downturn that lasted 13 days, where All-Star Financial Models lost only 3.8 compared to worldwide indices of negative 5 to 10. So really, when you look at the picture and you say, okay, what happened? We were pretty flat to the world, as was everybody else at the start of the fourth quarter. But it was the fourth quarter where we had that divergence, where the domestic market, because of the fear and the demand for the dollar and the demand for U.S. large caps, was basically buoyed up quite a bit, where the international markets, with that fear of oil and Russia, went the opposite direction. So hopefully that's a good explanation for some of the things that have happened. Just for fun, as you know, on our last page, we do a restaurant recommendation, the Nice Polonese. It's been in the Northeast for a long time, over 65 years. They've hosted many a sing-along, as you guys probably know. It's kind of that good hipster decor. Hey, before they close in the summer, let's get their recipe, Dave's Meatballs, and the kind of that comfort food we want to give you. That's a great recipe. When we do this, we ask the family to make it, and or Dave to make it, and then we tested them. They are awesome. And then quote of the quarter. This is from Mark Twain. It's one of my favorite. Kindness is the language the blind can see and the deaf can hear. So again, some food for thought to go with that. We also want to thank everybody for their continued trust in the All-Star team. It's really tough year for us performance-wise because of that last quarter where the market went up 5 to 10% in domestic and internationals went down 5 to 10%. But again, remember, it's the long term that we want to focus on. And again, contact us as many times as you want. We want to make sure that you understand our new teammates here, our Brian Sensky and Karina. Welcome with open arms. If you have any questions, give us a holler. We'd love to have continued referrals. We grow. Basically, 80% of our growth comes from you as clients and referrals, and we really, really appreciate what you've done for us and look forward to talking to you next quarter if we don't have a visit with you this quarter. Have a great day.